where education meets opportunity. This is ESG in the capital markets. Hi, welcome to ESG in the capital markets. I'm your host, Barrington Miller, Director of Issuer Engagement at the Canadian Securities Exchange. Today, we hope to explore what it means to participate and be in ESG, what is an ESG program, and most importantly, just what is it? What are those three letters, and why is everyone talking about them so much? Today, I'm joined by John Vellone, National Lead ESG with BLG, as well as Lynn McGrade, National Lead Investment Management. They're both partners at BLG. Ed Olson, National ESG Partner with MNP. Richard Carlton, CEO at the Canadian Securities Exchange. And Dan Weinerman, Senior Director, National Capital Services. I almost forgot. Oh my gosh. Ross Orr, CEO of BacTech, proudly listed on the CSE. Let's introduce our wonderful panel. I'm going to start with John. John Vellone, please tell us a little bit about what you do.
Sure. I'm a partner at Bordenlander Gervais. I think you mentioned that, Barrington. Thanks for having me here today. We are a national law firm. We have offices across the country, Vancouver, Calgary, Toronto, Montreal. And we practice a wide range of, basically a full service firm. So we do a wide range of work for both issuers and investors relevant to today's discussion.
Thank you very much, John. Lynn?
Yes, thanks, Barrington, and nice to be here today. I am head of our firm's investment management group in the Toronto office. And, I come at the ESG perspective because we are seeing a lot more regulation of ESG requirements, both for fund managers and also for broker-dealers distributing product. And as well, our fund managers are asked almost every day, what are their ESG strategies? What are they looking for in the companies that they invest in? So I come at it from the perspective of institutional asset managers and what they're looking for as well. Thanks.
Thank you, Lynn. Ed.
Hey, Barrington. Thank you very much. Great to be here with all of you today. Leading this for MNP is interesting because you would say, what the heck do accountants have dealing with non-financial factors? And yet it's really quite interesting that we're heavily involved in looking at the financial impact of these, everything starting from climate-related risks and opportunities, all the way through to investment policies, strategies for boards to get better governance oversight of ESG issues and transition issues. And we haven't even started talking about the whole regulatory environment too, and changes that are coming through all the regulatory bodies. So all of these come together in this perfect mix of, many times more than not, I get calls from clients saying, where do we start? So that's the whole discussion we're hoping to have is to lay out a few topics and areas of concern that companies are dealing with. But we really kind of run the gamut right now and are really happy to have other partners like BLG in the mix too.
Thank you. Dan?
Thanks, Barrington, for having me. I'm Dan Weinerman. I'm with National Capital Markets, the Capital Markets Division of National Public Relations, a global public relations firm. The Capital Markets Division, in addition to being a full-service investor relations and corporate communications firm, we help issuers enter the ESG conversation or expand on their ESG strategies. So happy to be here today to talk more about that.
Thank you. And leading right into our issuers, Mr. Ross Orr from BacTech.
Thanks, Barrington. BacTech's a company that, as you mentioned earlier, has been involved in ESG unknowingly for a number of years, using our technology to clean up the mining process. There's 21 metals in a phone. Mining is going to go on. So if it's going to go on, what we're trying to bring to the table is obviously a clean and responsible approach to processing metals.
Thank you, Ross. And rounding out our esteemed panel, Richard Carlton, CEO.
Thank you, Barrington. ESG touches the public capital markets in a lot of ways. It's certainly one of the first questions that retail and institutional investors are asking companies that they have either already invested in or looking to invest in. And it's incumbent on company management to basically have a responsible story for these questions that are coming up. And as the exchange, we're really looking to help provide guidance to the issuer companies so that we can provide consistency of information in the hands of investors so that we can drive the sort of responses that and outcomes that folks are hoping for, which is a lower cost of capital for the most responsible players in the market.
Thank you, Richard. And now we're going to move on to what is ESG? Let's dive into it. And I'm going to start off with John from BLG. John, what is ESG and what does it mean to you?
Sure. We've been tracking this trend since I'd say 2010, but it's really picked up a lot of pace. I'd say 2018, 19, 20 through 21 of investors, primarily driven by the institutional investor market, but actually trickling across the investment community. Now we're seeing it ripple out wider, considering environmental, social, and governance factors as part of their investment decision-making process, in addition to traditional financial factors. So not in lieu of. Folks are still very interested in investing in a profitable business and earning their returns, but layering on positive or negative screens for these ESG factors. And a lot of people point to, a letter Larry Fink published in January last year, directly to the CEOs of the companies that institutional investors like BlackRock invest in, emphasizing how disclosures of a company's business must be, in their view, compatible with things like a net zero economy, how those disclosures should also demonstrate improvements to things like diversity, equity, and inclusion, as well as other key material ESG metrics in their business. What's interesting is I can't just give you a list of what these ES and G factors are. The relevance and materiality of each of the factors really do differ and vary for a particular company, depending on the impact the company's operations have on those factors, as well as the impact those factors have on the company's operations. So there really is an interesting, almost financial materiality test being applied to these broader, what we used to call CSR factors, now are called ESG factors. We've changed nomenclature a little bit. And what I would say is, prior to 2021, this was largely a market-driven phenomenon. These were voluntary disclosures, and there's a perception, and it's building amongst the issuer community, that failure to adhere to or tell an positive ESG story may result in you being penalized, whether financially or reputationally, by investors, potentially by employees, customers, suppliers, and other stakeholders who are looking at the story that you're telling. This all fits into the category of what us lawyers like to call soft law. It's not hard law. You can't point to an instrument that requires you to do something. And examples of that include things like Glass Lewis and ISS, two leading proxy advisory firms, which have made announcements that they may in fact recommend against voting for proposed director slates and nominees for publicly listed companies if certain types of ESG matters are not adequately disclosed or not adequately addressed amongst the firms that they review. Now, we're pretty lucky. That tends to be focused on some of the larger public issuers. It hasn't trickled down to the new issuer space yet. And maybe that's the market making some of the right decisions in calibrating where they're looking. However, in 2021, we have witnessed here in Canada a tremendous increase in the role for hard law obligations and implications around these ESG related issues. And we expect this to continue to flow throughout 2022. And I'll touch on that through my remarks today.
Thank you, John. I'd like to now turn it over to Lynn.
Yeah, and I was really going to pick up a lot of where John left off and maybe start to say what a busy year it was in 2021 from a regulatory perspective. And I thought, the issuers might be really interested in having that regulatory framework so they can put their 2022 plans in place, thinking within that framework. So just to give an overview, January 2021, we saw the Capital Markets Modernization Task Force come out with proposals of, increased disclosure on climate and also diversity targets. In June of 2021, we saw the OSC come out with their statement of priority, highlighting the importance of ESG and how they were going to start to implement new regulations and have policy development throughout 2021 and 2022. We saw a number of regulatory desk reviews coming in by the regulators, both in, not just Ontario and BC, across the country, really. And some of them were focused on asset managers, like the institutional investors, looking at what their strategies, what disclosure they were saying, looking for to ensure that the disclosure of what they say they were doing in the ESG was really what they were doing. And in the spring of 2021, we also saw OSC staff looking at a review of 48 large Canadian issuers and seeing in particular what their climate disclosure had looked like and how it had evolved over time since they did their last review. That led to, in September 2021, we saw the OSC hold a roundtable on for asset managers on ESG disclosure. So again, institutional investors and what was happening in that space. And very relevant for issuers was the October 2021 release of the proposed National Instrument 51107, that is a proposal for mandatory disclosure of climate-related matters. And as that is out for 90-day comment, and that will expire, it may have expired by the time this actually airs. So that's something I think in particular people should be focused on. It continued into November, where we saw the IOSCO, the International Organization of Securities Commissions, come out with their final proposals on sustainable related products and also disclosure. And finally, in November of 2021, we saw the CFA Institute release their global ESG standards for investment fund products. And even though that might not apply to issuers, as I say, any issuer that is issuing their capital into the institutional marketplace should be aware of how their story has to fit within those stories. So I think all to say, it's a very active space in the ESG area right now, and on the regulatory, on the hard law side, like John says, and issuers need to be aware of that as they're coming through with their plans in 2022. And I think 2022 is even going to be more active.
Thank you so much for that, Lynn. And I think examples of having seminars like this and panelists point towards that as well. Ed, what is ESG?
Thanks, Barrington. Well, this is a fun one because everybody, when they hear ESG, they immediately jump to the environment. And granted, that's the right thing to do because it is the number one priority the globe over, but it is not just environmental. And we are going to hear a little bit later from Ross around some of the social implications of the projects that he's working on, which is ideal. But the priority is environmental today. If you were to wrap all this back, I would say this whole idea of ESG is around evaluating those factors of how advanced you are as a company with regards to sustainability priorities and your strategy for those priorities. So what I mean by all of this is where you operate, are you exposed to modern day slavery, and do you understand that in your supply chain? Where you operate, what is the strength of your governance practices, and is ESG, or are those priorities actually baked into governance structures, strategy, risk management, that whole control narrative and control processes? This is a evolution of beyond financial. Investors want a financial return, but they want a financial return through sustainable projects and sustainable companies. So now understanding that these rules to the actual game of where you operate are changing. And if you want to continue being viable, you have to look at that macro picture and understand what is it that my stakeholders require of me? What is it that we value as a company and the value that we create? What are those relationships? And now how do you react to those relationships to address what is of concern to your key stakeholders? What is a concern to you as a company? And how do you paint that path forward on which are the targets? What's the direction? How do we show that we're on that right path and not just talk a good game? So this whole ESG is this factors, and that becomes the mix of, well, factors are not mandatory yet, like John was talking about, but you'd almost have to have your head in the sand a little bit too, because if you look at changing seasons and you know when it's getting cooler and leaves are starting to drop that winter's coming, we can look at Bill C-12 and we can say the feds have been coming at us with the Canadian Net Zero Emissions Accountability Act. We can see what the CSA is putting out. We know what ISSB through the International Financial Reporting Standards are doing. All these factors are pointing to mandatory is coming. And I would say this is the perfect time to sit back and go, well, what is our story and how do we start putting a framework around it? Because that's the process that ultimately will, and we'll talk about this a little bit later too, will need to be verified or audited or assurance practices over. So that's a bit of what I'm seeing right now, Barrington.
Thanks for that, Ed. And shifting to Dan, what are you seeing at National? And
Thanks,
what is ESG?
Yeah. To me, ESG is synonymous for a way of behaving. I think, especially post 2020, I think society is just demanding better, just wants an overall better quality in areas such as environment, in areas like governance and ethical behavior, and on social matters. And that's something that we've especially seen in the COVID environment, where we're prioritizing the health and safety of our community and some of the social movements that have emerged as well. Everybody in all sorts of facets of life are converging together to overall elevate society's standard for giving back and doing better. And I think from an issuer perspective, I've been a part of a lot of investor perception surveys. The overriding factor is always trust in a management team, trust in a company, in terms of when an investor deciding to invest in a company. And I would suggest that if you don't do things responsibly, you don't run your company in a manner that suggests the well-being of the people that you affect day in, day out, then that counts against your credibility. That goes towards negative connotations of trust, and that's something that you can't repair. There are a lot of mining companies out there. The technology is well established, open pit, underground. There are a lot of cannabis companies out there. So when you're an investor and you ask yourself, why pick this cannabis company over this cannabis company, it's trust in the management team to execute and take care of them as investors and their employees, that knowing that the employees are the lifeblood of the company. Those are the kind of things that matter at the end of the day. So to me, Barrington, the simple answer to your question is it's a way of behaving, which is now as important as the operating metrics of it.
Thank you. And before I move to Richard, we're lucky enough to have an ESG acting company, perhaps Ross Orr from BacTech. You can tell us what ESG is or means to BacTech.
Well, we've been at it a long time. We didn't really know we were at it. We didn't have a name for it. CSR was what the last I remember. But to us, again, it's the difference between being a developing company and an operating company is night and day with respect to this, because as a developing company, you don't have the funds to identify the needs right away because you're not doing anything. You're in the lab. You're taking samples. At the end of the day, when you become an operating company, then of course you can look in the rearview mirror and say, okay, we've ticked a lot of boxes along the way. What haven't we ticked? And so that's the way we're looking at it right now. Every step we take in the process, look over your shoulder, where have we come from, where are we going? That's really what it's about.
Well, thanks, Ross. And audience, stick around because we're really going to get into it specifically with BacTech in a little bit. So make sure you don't go anywhere. And last but not least, Richard Carlton, CEO of the CSE. What does ESG mean to you?
Well, there's really nothing I can add to the discussion that we've had already. But what I will say is this: is our position as the exchange, we want to make sure that the hard law isn't too expensive or doesn't represent too large a tax on capital, particularly for the early stage companies. So we'll be advocating with the regulators to ensure that there is proportional, I guess, footprint on the companies that aren't going to basically drive, whether it's mining, oil and gas exploration, technology, what have you, out of the public markets. That would be a tragedy from our perspective. The other thing that we're looking for, and I can guarantee you that over the course of 2022, we'll be working with the regulators on, is frameworks that provide for common understanding of the metrics that are being reported on, to provide as much guidance for companies that are, whether on a mandatory basis or voluntary basis, that are disclosing information on the E, S, and G components of their program. And I think it is fair to say, and I think this is a piece of the comments really from all of the panelists at this point, is I think it really will distinguish the skill of management teams, that if you have set an ESG program in place and you hit those benchmarks, just like you hit benchmarks for growing your customers, growing your revenue, EBITDA improvement, and so on, that it really will, the companies that do hit their ESG marks are probably the ones you do want to be invested in, because that is a significant sign of a more skillful, engaged, and capable management group.
Well, thank you, everyone. And now we're going to get into, let's talk about the trends that we're seeing in ESG. Let's talk with John. John, what are you seeing as trends in the space, especially for 2022?
Sure. I have kind of looking into my crystal ball, trying to predict what's going to happen, but I see three key trends emerging, and I'll do a little bit on each. The first is we're seeing a push towards some mandatory or hard law requirements rather than voluntary disclosures in certain select ESG topics. And the areas where we're really noticing this relate to the transition to the net zero economy. So in October, the Canadian Securities Administrator published for feedback a proposal on climate-related disclosures. I need to say right at the outset that when regulators are looking at transitioning from what were previously voluntary disclosures to mandatory disclosures, it's pretty important to assess and understand that mandatory disclosure obligations like these do drive incremental costs and administrative burdens on all the disclosures on the one hand, and that does need to get weighed against the incremental value created by those disclosures. But not only that, when proposals like these are out on the street, they tend to have the effect of creating winners and losers. And a lot of times the organizations and institutions that are impacted by these new requirements don't necessarily fully understand what's at stake. So I'll give this one example, this proposed National Instrument 51107. It ties into some global standards, Task Force on Climate-Related Financial Disclosures pretty well, except that it's currently proposing to only require disclosures of Scope 1 emissions, not also Scope 2 and 3. That creates winners and losers depending on which industry you're in. If you're in mining or you're in like a manufacturing industry and you have large Scope 1 emissions, your reporting is going to show high numbers. Versus those, if you had to include Scope 2, you'd have folks in the cryptocurrency space or folks in the cannabis space that have large utility-related demands showing an increase in emissions. Current live debate right now, whether or not mandatory disclosures are going to include Scope 1 or Scope 1 and 2 or Scope 1, 2, and 3. And I'm not sure I'll all your issuers, for example, just understand what's at stake here, depending on what's determined on that. Not only that, but let's just look at Scope 1 emissions on their own. Large emitters, those above 10 kilotons a year of GHG emissions, already are required to disclose under federal environmental law their GHG emissions. So if you're above that magical threshold, this isn't really going to be an incremental burden for your Scope 1 emissions. But if you're just below that, if this becomes law, you're going to have to look at hiring a third party to help you track, measure, manage, and report those emissions going forward. So I see a push towards mandatory rather than voluntary disclosures happening. I'm not sure I'm seeing the public debate that needs to happen around it. I know the CSE is planning to make submissions on that particular proposed national instrument, and I expect some of the points I raised are going to be echoed in those submissions as well. The second big trend I'm seeing is a drive towards standardizing use of terminology and creating a common set of definitions to facilitate an accurate discussion around these topics. Because quite frankly, when I look at it as a lawyer, there's a lot of messiness on ESG with regards to use of language. And I'll pick a very simple one: diversity. Everyone will say diversity, equity, inclusion is part of your social kind of category of ESG factors. What do you mean by diversity? Well, what I can say is the hard law doesn't have a consistent agreement on what is meant by diversity. You look at, National Instrument 58101, diversity is gender. Gender disclosure requirements have been existing in securities law since 2015, but it doesn't go further than that. You flip over to the federal law, Bill C-25, and you look at how they define diversity disclosure obligations for distributing corporations under the CBCA, and it's a bit expanded. I'd say it is a bit expanded. It's gender, but it also includes Indigenous persons with disabilities, members of visible minorities. It's in a slightly expanded definition. I can't currently point to a hard law obligation that has diversity that includes LGBTQ considerations as well, even though as a group, we'd probably all agree that probably fits in that category together. So I expect to see throughout 2022, just a streamlining and convergence on the use of terminology. So we all know what we're talking about when we say something simple like diversity. And the third trend I'm seeing is really an increased focus on risk management around all of this ESG disclosure and this ESG topics. Lynn mentioned this in her opening remarks, but we've already seen securities regulators, both in the US and in Canada, conduct what we called green sweeps of certain investment management companies, specifically focused on their ESG related disclosures and the internal processes, protocols, and procedures they had in place to backstop what they were saying in their public disclosures. Those regulatory investigations tend to produce, from time to time, major investigations. In the US, we are actively tracking one of those, the EWS group. It's the asset management arm of Deutsche Bank. After the firm's former head of sustainability was cited in a Wall Street Journal article alleging that EWS overstated how much it used its sustainable investing criteria to manage its assets, the SEC commenced an investigation. They couldn't ignore that Wall Street Journal article. And it is the first major kind of investigation into allegations of greenwashing we're seeing. And we're expecting that plaintiff counsel, class action counsels are tracking these types of trends pretty closely, because it is, with the loose use of terminology, it is relatively easy to make an allegation of misrepresentation, because it's so hard to pin down what people mean by this terminology. And the real question is whether you can prove it in court and whether you can prove damages associated with it. So as folks are focusing on this risk side of these disclosures, the importance of internal processes and controls and clarity in your public disclosures are really going through the roof. And folks in accounting firms are being called in all the time to help implement audit and procedures to help increase the veracity and data backing of these ESG disclosures. We are nowhere near where we are with our financial statement disclosures and the audits and consistency of the data that go out with those on the ESG space. But we now know investors are considering that information and making a decision. So I think it's just a matter of time before we start seeing misrepresentation claims showing up in court.
That flows nicely. You know where this is going next. Ed, take it away.
Thank you. I already took myself off mute and I was going to start waving at you, Barrington. But John, I would say yes, all the trends with the implementation and what companies are going to have to do and what CSA is coming out with, and even the dialogue between scope 1, 2, and 3 emissions. You know, somebody's scope 1 emission is another scope 3. So this whole interrelated how carbon footprints are going to be calculated. It's just a matter of time. And I think we're very interested right now around transition periods to allow for those mid-size or smaller entities to be able to adapt and implement. And it's not a one size fits all. So it's something we're very cognizant of. But the one I wanted to get into is you're absolutely hammering the nail on the head right. Assurance activities are going to be fundamental. And I say this because when banks implement and put in a cost of capital related to your sustainability activities, they're not just going to have you as a company say, we did it, and they're going to go, great, we trust you. No, investors aren't going to look at your report and say, you know, we're a good company and here's all that we're doing. Great, but we need somebody to come in there and kick the tires and look at whether or not it's in place. And the entirety around data integrity, data custody is so fundamental that if you will be reporting on it or making decisions on it, you have to reverse engineer back through the management processes and those risks that drive the right controls so that that is completely tied together, well understood by a company, and it is actually verified so that the outputs and the report, when it's audited, you can have it stand on its own 2 feet. Because if it doesn't matter how many beautiful pictures you put into it, there isn't going to be the value at all. And stakeholders like banks and your investors and insurance companies and, you know, pension funds that are looking for long-term returns, they don't want to invest in a company that's going to be at risk to physical risks or transition risks. All of this comes to play now. How robust is your reporting? But can it stand up to a third party auditing it? That's why the International Financial Reporting Standards through the ISSB is working with the International Accounting Standards Board, and they're trying to align what does that assurance activity look like. So it's huge and on our radar, and every accounting firm is grappling with this as well.
No, thank you both. Let's continue with trends that we are seeing or that you're seeing for 2022. Richard, at the CSE, what are you seeing?
Well, again, I've talked about it a few times, Barrington, and that is really the hunger for some assistance from the issuers, especially the smaller issuers, in terms of what they need to do, how they should do, where the resources are that they can call on. Right. Again, these aren't companies that have dedicated departments that can go out and identify the appropriate scientific and legal and accounting consultants that they need in order to implement a program and so on. So, we will certainly be, again, and are doing so today, hoping to provide information and, a starting point for their search for the necessary for the necessary skills that they're going to have to take on in order to even on a voluntary basis develop a program that is consistent with the disclosure standards. It is interesting, when I sit back and think about the CSE and our own footprint on the world, because we're obviously not smelting resources, we're not refining petroleum products or whatever. But, we do have a significant electricity footprint at our data center down at on the base of Parliament Street. And when we look out the window of our lofty quarters at King and Bay Street, and I can actually see that there's a peak natural gas power plant that's located within a few hundred meters of our data center. That tells me that from time to time, we're not just running off of Niagara Falls and Pickering. We're actually contributing fairly directly to the emission of carbon on the Toronto waterfront through that peak power production station located nearby. And then again, you think about, all right, well, we also draw people from all over the GTA, the commuting, the cars, everything else. And, again, I talked about our lofty premises at First Canadian Place, the elevator rides 1 minute and 5 seconds to get to the top. That's not coming free. So there's just a lot to think about as somebody, in a leadership role for an organization where you think, well, yeah, no, we're clean, we're good. Yeah, maybe not so much when you actually think about the full range of activities that you're undertaking.
Well, that's really true. And Lynn, with being the leader of the National Investment Management team at BLG, what are you seeing as some of the trends, perhaps for 2022?
Well, I think just to put it in context, certainly the institutional investors are going to also be subject to their own increased disclosure and regulatory environment, as I've mentioned. And I think what that's going to do is, as people on the panel have mentioned, is flow right down into the issuers. So people, and issuers are, I think, trends to expect is increased due diligence inquiries by institutional investors, benefits of getting more access to capital if you have your story started. So, some of the trends, I think, just we're seeing boards wanting more information, more education on ESG. We're seeing C-suite. We're going out to many of our largest clients and certainly have that expertise to bring to smaller clients as well, but just basic education about ESG, how to start a program, step by step, just how to get this underway, because I think every issuer can expect that it's going to become an increasing topic of importance for the C-suite and the board.
Thank you. And Dan, what trends are you seeing for ESG in 2022?
Right. I think building on Lynn's comment, I think even if you take the view that the mandatory disclosure is going to take a little longer than expected related to ESG, you're almost conspicuous by your absence now if you don't start thinking of these things and you don't start communicating these things. I think issuers are going to see, and they've already seen in last year and the year before, that the risk of being screened out of potential ESG funds exists now, not just when the disclosure takes effect. So I think that's a trend that we're going to be seeing certainly in this year, is that there's going to be more companies entering this arena because they know that they're going to miss the boat if they don't do this now. I think that's the first thing. And then from a communication standpoint, I think more and more companies are starting to be creative and starting to get out there communicating their strategies and communicating the initiatives that they're doing as a company. I think companies are realizing that they don't have to have all the answers as it relates to ESG and communicating to frameworks and having all the initiatives in place. But as all the panelists have been saying throughout the session today, they all have some stories to tell. They all have stories to tell, and they all have priorities within their organizations. And I think those stories are starting to come out, via social media, via ESG reports, things of that nature. And I think that those things are going to be more prevalent as well in this coming year. Is companies are going to look for even more ways to try to get those stories out. It's still not part of the sort of everyday thinking of milestones and reporting. So companies do have to think through when they're going to report these and the frequency that they're going to do that, and maintaining a presence via the web, maintaining their presence via social media. All those things are going to be important in telling those stories and making investors aware that these are the things that they're prioritizing as an organization.
Well, thank you. Thank you all for that and in discussing the trends for 2022. Now, I'm going to throw some wrenches out there and we'll see where they land. That's just a little dodgeball movie reference. And now there are some companies, or the argument's being made that bigger companies don't really need to do it. And I'm leaning more towards mining companies and mineral exploration. They don't need to do ESG, nor do they want to, because they're making money hand over fist. And the smaller companies are the ones who are really suffering with ESG because it's taking away perhaps from the cost is taking away from their actual business of exploration. There are some people who believe that ESG is a temporary fad, that it's just another moniker to put on to help differentiate yourself. But, after the next few years, it'll start to level off. Not my opinion. I don't believe it, but that's what some people are saying. Is this ESG thing a temporary fad? Is it just passing through? Will it level off? Right. I think we had some discussions outside of this arena with panelists here that it will taper off, but right now it's skyrocketing up. So I'm just throwing those out there. Not my words. Whoever wants to latch on, please feel free.
So yeah, I'm biting at the bit for that too, Barrington, because let's reference something back. I'm an accountant, so I'm going to bring this out right now. If we go back to even the Sarbanes-Oxley era of how that evolved, it came from poor reporting, fraudulent reporting, misleading reporting, and people were saying, well, I thought these big companies were doing the right thing. They had all the right disclosures. We relied on them, and investors lost a lot of money. That whole event, that mindset literally changed what the expectations were around what needs to be in place for the core fundamentals of control and management systems and risk management. And it led to assurance activities to put more reliance on the financial reporting, that when the CEO and CFO sign off and give their certification that everything is complete and accurate and they can validate that, great, we've got a more robust structure in place. SOX hasn't left. And in fact, it's here to stay. And I see ESG very, very closely in the same light. This is a fundamental shift that will change expectations. And we're trying to be cognizant of different sizes of organizations that, if, like you said, we're talking about mining. We can look at the Mining Association of Canada, and they have an incredible document called Towards Sustainable Mining that has incredibly robust approaches around all these sustainability issues. And any Canadian mining company is applying it to their global operations. So there's a lot that's already in place that we can move forward and leverage and then build it into the ESG framework itself. So to me, this isn't going to go away. If you look at SOX, it never went away. The robust and the rigor of what is applied today is there. I see the same thing coming through ESG.
Okay. Anybody else?
If I can, I'll keep going on that theme,
yes,
and I think we're at an interesting point of the conversation because we've gone from a period where, at a very simplistic level, oil bad, mining bad, big tech, yeah, probably okay because they seem to score well on some of these things, but a very not a terribly sophisticated understanding or review of what's going on or the relative measures amongst companies in a particular sector, how they perform against many of these benchmarks. But I think we're coming around to a point where, and you hear this like literally every day in the newspapers, people talk about, well, the electrification of the economy. We want to reduce the intensity of carbon emissions. Okay, great. So that means electric cars. It means more electrification of different industrial processes and so on. Well, guess what? A couple of things. One, it's got to come from somewhere, right? That energy has to be produced from somewhere. And if we're going to continue to invest in technology, we're going to need rare earth metals. We're going to need more copper. We need more nickel. We need more zinc. We need more cobalt, lithium, graphite, you name it. So we're going to have to continue to mine. We're going to have to continue to produce fossil fuels, right? come to an understanding and agreement that that is in fact the case. So at that point is, how do you encourage a reduction in carbon intensity in each one of those industries? And that's where you're going to have to develop the standards, the reporting, the sophistication at the investor level, where they will in fact reward the companies who execute better on these strategies within the specific sector. And I mean, a perfect one is the energy sector. 80% of the world's petroleum is produced by state-owned enterprise, right? And they are impervious to cost of capital concerns from public markets. The other 20%, the Exxons, the Suncors, the BPs, Royal Dutch Shells, those folks, they are intensely interested in figuring out how to reduce emissions, to continue to receive investment from the public and private capital markets. And they're the ones you can lean on. I mean, Exxon actually gave up a board seat to an environmental activist as a result of an activist investor attack over the last few months, right? I mean, that's a generation ago unheard of. But they did, and I can guarantee you that there will never be an environmental activist on the board of Aramco, Petrobras, Sinopec, any one of a number of state-owned enterprise that I could name. So this will work. And I think we're coming to a point where, again, the sophistication is coming in, where it's not just oil bad. It's, well, no, we need to have a better understanding of how we affect the outcomes that we need, and reward the companies that, in fact, are the responsible actors in a particular space.
Oh, well said. Well said. Lynn, did you want to?
Yeah, I guess I think of ESG maybe is not so dramatic. It's almost like a redefinition of what it means to be really running a company well. And in that sense, I don't think that's going to go away. I think ESG, and another thing I was thinking about, Barrington, is another thing to say is, well, and I liked Richard's point where he talks about elevators and things, like a company that's not in mining, that maybe is just doing, consulting or something, might think, well, ESG doesn't apply to me because I'm not a mining company. But I think everybody should know ESG is defined very broadly. It is governance. It is how you treat your people. It is everything more broadly, and it applies to every company. And it really is not going to go away, because it's almost like a new way of defining really what the things you have to take into account, and how you tell your story is how you run your company responsibly and in a well-managed way.
Oh, thank you. Dan, is this a trend that's here to stay? A bunch of companies come in, they want to get their story out, and then maybe their stock price goes up, maybe it doesn't, but they're using it as a tool just for the short term, or is this a little bit deeper and more meaningful?
I do think this is here to stay, Barrington. I think it's building on what Lynn said as well. It's becoming the way people are doing business as well. I think that investors are looking at more than just the bottom line now. They want to see that sense of responsibility, and I think there's this notion, especially when you talk about mining, of leaving the earth, leaving your footprint in a better place than when you arrived. So I think there's a lot of mining companies talk a lot about remediation and their plans toward that. So there's this idea of continuity years after these mining companies have left these jurisdictions. That there are mining companies that operate in provincial parks, and the idea of remediating a footprint within a provincial park, and then later going to that park and not having any traces of a mining operation. I think that's something that company or companies like that do those kind of initiatives should be very proud of it. And there's this idea of leaving things better than how you found them that I think is inherent in all of us as human beings, and I think is coming over to the issuers as well in the business sense.
And that's what we're trying to achieve in panels and discussions like this, making and helping our audience and our listeners be more aware after listening than before they jumped in. Now, I want to move to the next section and let's discuss specific industries. I know right off the hop we mentioned a lot about mining, and we have one of our panelists, Ross Orr, CEO of BacTech, listed on the CSE, who can talk a little bit more about what they're doing ESG wise. But mining isn't the only one. I know, Dan, you mentioned cannabis a couple times during the conversation. We were talking with John offline, and he said actually it was I think it was the financial sector is one of the larger, and people wouldn't think of it when it comes to ESG, of being at the top of the leaderboard when it comes to that, but it's in fact true. So let's break down some specific sectors, and whoever wants to take the lead.
I might jump in just because
Sure.
that dovetail, but it is the banks. It really is, and the financial services sector overall that's driving this market trend, this voluntary trend that we're seeing in Canada today. You know, each of our major banks in Canada have set aside allocations of capital, both for ESG equity investing. They've created all these ESG funds that their retail investors are buying into, but they've also set aside a portion of their loan book for sustainable finance instruments, green bonds, blue bonds, sustainability linked bonds. And the number of issuances of those types of instruments I saw in 2020 in Canada, we had like 4 sustainability linked bonds that I could point to. In 2021, I had to stop counting because it was, 3 a week for weeks on end. And those banks are actually tying cost of capital, your interest rate you're paying in those loans, directly to your performance on select ESG criteria. And the idea is simple, and the banks are kind of driving the trend, but if you don't measure it, how do you manage it? It's as simple as that. And so they're creating incentives for whether or not you're a public issuer, the disclosure of information so as to create measures, so as to drive improvements in managing those outcomes. We are a long way from where this started with negative screens on sin stocks and things like that. We are really at the point where investors are looking for the best performers in your industry, acknowledging that you are going to have certain impacts in that industry. They're looking for the top performers in each of the industries they're looking to invest in, including the oil and gas industry. They're just looking for the best amongst the group.
If I could just add a little bit on the whole finance side of what John was referring to, if we just look at last year, Canada's big 6 banks all signed on to the Net Zero Banking Alliance. And when you think of the gravity of that, if you peel back the details of what they're trying to achieve.
Sorry, Ed. What is the Net Zero
Banking Alliance?
Yes.
Well, this is what they're after. Is they want to band together globally financial institutions to drive change through their finance mechanisms. And what I mean by that is this. Through their 2050 net zero target, so they want to have net zero financed emissions. So anything that goes through them to a company should be net zero by 2050. And the thing that I'm most interested in right now is by 2030, they want to half 50% of financed emissions. And that's not a long period away from where we're at today. So if you consider those financing mechanisms, yes, they're going to start with the larger organizations and offer those finance mechanisms like what John was referring to, but it's now going to start cascading down even after 2030, that everybody who wants a loan or needs to access bonds or have other type of finance mechanisms in place, they will need to articulate their sustainability story and strategy and ensure they are aligned with this net zero of what the banks are trying to achieve. Otherwise, thank you for the opportunity. You'll have to chase your business somewhere else. And I think that is a very leveling conversation around why yes, investor or issuers need to look at investors, but they also need to look at the banking industry too. So that net zero banking alliance, I'm watching that really closely.
Yeah, although that obviously runs the risk of eliminating whole sectors from the investment program, and that's what's dangerous. I mean, obviously, as the operator of a stock exchange, it would be shocking to learn that I'm in favor of market-driven solutions to various problems. But we need to make sure that the right checks and balances are in place to ensure that capital is in fact allocated to the more skillful management teams and the ones that are in fact acting properly within particular particular industry sectors. Now, it's not obviously just the banking concerns. The insurance companies are also, whether it's a result of pressure from different groups, but are also withdrawing insurance coverage from different industries in an attempt to basically cover themselves off in terms of their own activities. But in doing so, have the effect of making some significant operations considerably more expensive. Again, I think there needs to be some subtlety brought to the table here. And right now, these instruments, I'm suggesting, are perhaps a little too blunt to achieve the appropriate response.
If I could just add a little bit onto what Richard said, Barrington. Look, Richard, I'm with you on this. I think the whole idea of all or none is not the right strategy. And let me maybe here's a little bit of a caveat. This is Ed's opinion and maybe not that of MMP. If we say we want absolutely none of, do we truly understand the implications and the risk that comes to the global economy? What happens to our country? What happens to local jobs within communities? I don't think that full picture has been fully understood. And so if we charge down a path of all or nothing, it brings a lot of risks that people aren't starting to consider. And I worry about that. Now, does it mean that we can still be good stewards and tell our story and work towards a more sustainable future? Absolutely. But let's be cognizant of the steps that need to go in order to move towards it, and not just we're all panicking and running for the door.
No, I couldn't agree more. Let's keep going on the specific sectors that would and could be affected by ESG. Dan, you had mentioned cannabis. I don't know if you want to go into that or whatever you're seeing from National's point of view.
No, sure. It's interesting because you mentioned mining and cannabis, and in a way, they both are dealing with safety as a bit of a stigma in each of their industries. Mining for years has been associated as being dangerous and unsafe, and I think that there's been a concentrated effort, and Ed mentioned the towards sustainable mining. They're very big on the health and safety of the industry as well, and zero lost time accidents, things of that nature. So mining is coming at it from a place of, and we're seeing more of this, is how are they influencing or how are they directing a more safe and healthy culture within their organization, so that employees are going into work and leaving exactly in the same shape, so that there's no inherent risk to the actual job that they're doing on site. So that's interesting. And cannabis is dealing with safety in another way. Cannabis in and of itself, recently legalized, it was a narcotic at one point, and there were risks inherent with the overuse and things of that nature. So there is a bit of an idea that cannabis companies have in terms of the safe distribution and packaging, making sure that it doesn't get in the hands of minors, things like that. Cannabis also, and we're seeing in particular with the US MSOs, a lot of them are on the CSE, the issue of social justice reform is big for them. War on drugs was not too long ago in the United States, and a lot of minority disadvantaged peoples were affected by the war on drugs. Now that U.S. federal regulation for adult use is being at least contemplated, and medical and adult use is allowed in certain states, the U.S. the larger U.S. MSOs are starting to think through, how do we rectify these wrongs? How do we get these people, knowing what the laws are now, knowing where the legislation is going, how do we right those wrongs from the past? So a lot of them have weighed in on their social agendas, and we're seeing that across the board from the U.S. MSO space.
Thank you. And I just want to give, now this is the part where I do a little bit of plugging for the Canadian Securities Exchange. You can find out some of those issues and topics that Dan mentioned. There's an organization called the Last Prisoner Project with our good friend Steve D'Angelo. We did a series or an interview, part of the series, the Cannabis Investor Series, which you can catch on CSE TV, or you can go to our website blog, www.thecse.com, and find out more. He did an interview with our good friend and colleague, Anna Sarin, who also does the weekly market recap every Friday, 2:15 Eastern Standard Time. Now, that's it. That's the plug I'm going to do. But it's true and it's relevant. And you also, I started laughing when everybody was talking about mining, because I did an interview with Rob Cook with a company, and for the first 20 minutes, it was a mining company, and we were talking about various policies and things of that nature in order to list on the CSE. And then they said something, and Rob and I looked at each other and said, well, what kind of mining? And they're like, oh, blockchain. Like, oh, so we had a 20-minute conversation on mining. The language was the same. Everything was the exact same until we realized it was. So yeah, and it goes back to Richard's point of talking about mining, and some of these companies, especially in being offered Northern Ontario, there's an abundance of water. Just go ahead, go nuts, hydroelectric, go crazy, and same thing with Quebec. So I found that really interesting. So just thought I'd put those points out there.
I mean, it's interesting, Barrington, thinking about the crypto space, because the ESG factors are, diving straight into that industry as well. Originally when we saw crypto issuers showing up in Canada, they were surveying jurisdictions for lowest cost of power. Where do I site my mining sites to minimize cost of generating new crypto assets? It's completely changed over the last year or so, where they are incredibly concerned about, or some of the issuers, I would say, are incredibly concerned about their scope 2 emissions. How green is that power that's coming into my data center? And they're looking at jurisdictions like Quebec and Manitoba that are hydroelectric driven, as opposed to jurisdictions like Ontario, where we have some natural gas in our fleet. Or they're looking at entering into virtual power purchase agreements with wind farms and solar farms to offset some of the emissions that they're seeing. And that is driven, I think, in large part by investor perception that these forms of currencies that they're generating do have a relatively significant energy use and a potentially significant carbon emissions footprint. Oddly, we don't measure our current currencies by the same token, right? We don't look at fiat Canadian currency and measure the carbon emissions of that, but I'm sure they're huge, right?
Well, and you got to take a look at the energy consumption of even the transactions being processed by block, let alone what it was for the mining. And there's a big dialogue between all the different blockchain and cryptocurrencies as to who's more efficient and effective and ESG compliant. So I agree with you, John, on that.
Yeah, that's I still remember this was more than a few years ago, but yeah, they're like, come up north, just use the water, just power, and wattages per minute and all of those things. Then it went quiet. It went really, really quiet. And like you said, they're kind of like, okay, is this compliant? Am I doing this okay? And then you're starting to see, well, we're mining and we're doing it the right way, or at least we're trying to. We're making an attempt. So invest in us.
Although, unfortunately, we're going to see the law of unintended consequences rear its ugly head, and in fact already are. So that people should be aware that there is a run on vast swaths of the boreal forest in Ontario being purchased by third-party investors as carbon sink offsets to their other activities, particularly in the crypto mining space. So, be careful what you wish for sometimes.
No, that's definitely true. So now I would like to move over to our guest, our company, our resident company, Mr. Ross Orr from BacTech, to provide some specific examples, and hopefully we will be able to generate some discussion based off of his examples of what they are doing and how they're behaving as an ESG compliant company. As I introduced earlier, Mr. Ross Orr, CEO and president of BacTech, proudly listed on the Canadian Securities Exchange, who was doing ESG before ESG was even a thing. Ross, let's talk about what your company does and how you're involved in the space.
Well, Barrington, I think initially what we targeted were tailings, because the world is full of tailings. And of course, tailings generate acid as the sulfides break down. We happen to have a technology which is bioleaching, which is our tagline is our bugs eat rocks, because that's basically what they do. They break down sulfides, and then we use conventional mining technology to recover gold or to precipitate out arsenic in a stable form. So we initially started off just trying to clean up the mess that was left behind. The trouble is that big mining companies that have tailings don't want you to touch them because they've got a bond in place. And if the government says that's a good state, then that's a good state. So we tripped over Ecuador, and we go chasing arsenic. That's our main element that we look for, which effectively leaves the market 100% to ourselves, because nobody's crazy enough to chase arsenic except us. There's an area in southern Ecuador where they produce a lot of what they call arsenopyrite, which is the sulfide mineral that contains gold and arsenic. The miners there have been shipping concentrates to Asia at reduced prices. They get 65 cents on the dollar for their gold value. Recently, the market changed because the Chinese government actually imposed an import tax on arsenic. Now the miners are getting less than 50 cents on the dollar. I don't know if they're even making any money at that stage. So enter BacTech. We're going to go back to the prices they were getting, 65 to 70 cents. We're going to process their material, and we're going to send them home with a paycheck, obviously, and to survive and to continue their business. They're going to mine no matter what, whether we're there or not. But the reality is that we can make a very, very positive change, not only to their lives, but also to the environment that they live in, because the arsenic's not going out into the tailings. Now, as an ESG company, as a junior company, I should say, in the ESG space, it's very difficult because we scratch and claw every day to raise money, and to be hit with all of these ideas of what we're supposed to be doing before we're even there is very hard for us to wrap our head around it. I would say as a junior company, once you get into production, or leading up, you're going to production, that's when you can start to address the issues. And I'd like to bring up two examples. One is we bought 100 acres of land in an area called Tangal, which is next door to Ponce Enriquez. It's full of cocoa trees. And the day we went to look at the property, we drove in, and there were about 10 guys standing there, and I could see it in their eyes. It's like, oh no, what's happening? We're going to be out of our jobs. And we went and saw the property. It was exactly what we wanted. And it dawned on us later, we said, look, we're only going to be using a small portion of this particular property in the short term. Why don't we allow these guys to continue to farm and keep the product for themselves? We're not in the cocoa business. We're in the processing of high arsenic concentrates. So by allowing these gentlemen who are employees, I guess, of the former farmer, to take control of their own destiny and continue to farm, this cocoa for as many years as we can, is something that I think is going to bring a lot of goodwill to the area where we are, and it solves a problem. We can empower these people to go off and do something to make money for themselves, as opposed to throwing them out on the street, which is unfortunately happens a lot in mining. So that's one example. The other example is that, we've just completed our feasibility study. This is a very, very profitable project that we're working on. Ecuadorian law states that 15% of your EBITDA goes to the employees. Now, we're going to be paying 35 people a decent wage for Southern Ecuador. It's about $1,000 US a month. Their bonus will be $40,000 based on our numbers. So what you're doing is you're basically taking 35 people and saying you just won the lottery. And we all know what happens to people that win the lottery, right? Things get out of control. So what we have to sort of introduce there are savings for education, savings period, trying to keep family units together, because money can cause all sorts of problems if it's dropped into your lap in a lump sum, so to speak. No doubt will be the most popular company in the area to work for. That just goes without saying. So these are the types of issues that we're going to address as we go forward. But to try to put a pin in it today is very difficult to do for a small company.
Ross, you've hit on so many topics that we're dying to get into, and unfortunately, we can't get as deep as we'd like to. But I don't want to ignore some of the things. So, I'm an investor. I'm in my 20s. You've hit and checking off a lot of boxes that are existing, and we've talked about this as a panel, off screen, on screen. These are the things that capital markets professionals are looking at. These are the things that current investors want to do. And I'm going to point towards Richard, because he had stated earlier that if you have an ESG program or you're acting ESG compliant, the chances of you getting more money has increased. It's not guaranteed. Nothing is guaranteed, but the chances of you receiving more money based off, instead of somebody who has an equal business, is a lot more. Richard, do you want to go into that just a little bit?
Yeah, there are a lot of different themes, Barrington, involved here, because on the one hand, we're looking at, and Ross referred to this, potential mandatory reporting of certain carbon output or carbon emissions, according to one of the global standards that is emerging on all reporting issuers in Canada. The Canadian Securities Administrators currently have, by the time we see this, the comment period will have closed on, in particular, the environmental impact of different companies. And the intention of this, of course, is to try to identify which companies have a program in place to either address or reduce emissions, and which ones do not. So that, in theory, anyway, investors are able to make comparisons amongst different companies in a particular sector and determine, if this is important to them, which are the companies that have their act together when it comes to managing and reducing the carbon impact of their operations. But at the same time, as Ross said, this is going to be a very challenging activity for particularly the junior companies to initiate these sorts of programs. It ultimately will be very expensive, I think, for many of these companies, and not just in the mining and oil and gas exploration space, but really across the full gamut of the early stage public company market. So we have to take that into consideration. But I think the key thing, and this is the role that we prefer to play from the perspective of the Canadian Securities Exchange, is really to provide clear disclosure standards for companies that are listed on the exchange, so that they have a framework that they can trust when they talk about not just the environmental impact, but also the social and governance components of their program. Because, as I said, there's no doubt that if you have a compelling ESG story, your shareholders and prospective shareholders will be more drawn to the company, and that will enable you to, as you come back to market for additional growth capital, make you or help you stand out from your peers in a particular industry sector. Now, the big concern, of course, is we've heard this phrase greenwashing, that companies are in fact being a little overly promotional, shall we say, when it comes to some of the aspects of their ESG program. And that's really where us and the other regulators in the marketplaces really need to step in, and by providing both the framework and also monitoring the disclosure of these issuers to ensure that in fact people are playing by the rules. And again, as I said, the ultimate goal here is to make sure that people are in a position to provide or at least obtain a comparison between companies in particular industry groups and determine on the basis of their ESG programs whether this is somebody comfortable that I'm with giving them my money.
Thanks for that, Richard. I want to go around the horn with our panelists because and it's going to be a little uncomfortable, but I'm a company like BacTech. I'm or equivalent, and I might be struggling with, and I'm not saying BacTech is, but I might be struggling with trying to live up to these ESG standards while balancing my balance sheet and keeping shareholders and happy, as well as doing what I'm supposed to be doing, which is the operations of the company. Ed, I walk into MNP's office. What would you tell me, or what advice would you start to give me so that I can help navigate this new sea of ESG? Not to rhyme too much.
Barrington, it's almost like you were in my office yesterday, because that's exactly the questions that we get. There is an idea of materiality, that threshold of what is most important to your organization. You're not there to deal with absolutely every ESG topic that comes out of every ESG standard or framework. It's a matter of every industry, every sector, every company has a bit of a different profile and how they actually address it. And the other thing that I like to give a little bit of that calming source of, you're better probably than you think. If we start looking at critical issues or topics, risks and opportunities within your particular industry, let's do just a stop for a second and evaluate, what are you doing today? And like with Ross, there are a lot of things that you're already doing. So when you dovetail that with the expectation of investors and the capital markets, even banking and finance institutions, they will see that there is a direct linkage, which will help you identify, well, sure, there's still some gaps. How do we start filling those gaps over a prudent period of time? That's the methodology and the strategy versus an all at once.
Thanks, Ed. And now I've wandered into the offices of BLG, and I'm struggling with trying to be ESG compliant as well as do my business. What advice or what direction would you give a company like Ross or Barrington Inc. that wanders in wanting to do ESG properly?
Certainly. From my perspective, the first thing we look to are some of the hard law obligations, things like mandatory disclosure obligations, proposals like these carbon emissions disclosures that Richard mentioned. Make sure you check all the boxes on the mandatory disclosures. Once you get into the voluntary disclosures, that really comes down to an exercise in storytelling. It seems to us, if you're not telling your story today, someone else probably is, whether it's in a third-party evaluation agency, someone else is telling your story to those investors. So there is value, kind of economic value, in telling your story to your potential investors, making sure you do put your best foot forward. And when doing that, what we look to is what standardized terminology and set of language are you using when you're telling your story to make sure it's correct. It comes down to greenwashing and perceptions of greenwashing and avoiding concerns around misrepresentations when telling that story. We are seeing best practices are this storytelling exercise generally needs to start from the top and work its way down. It starts with the governance practices at your organization, at the board of directors. Do you have a committee on your board of directors that is thinking about these types of what, as Edward said, these material ESG issues, the ones that matter for your company and the stakeholders that are affected by them? Do you have a stakeholder committee or a governance committee that are thinking about that? And then implementing internal controls and processes to monitor impacts, report it back, and help inform your storytelling exercise.
Thank you, John. Before I go to Lynn, I want to dovetail to Dan, simply playing off of the storytelling aspect, and that's literally one of the things that we talk about for companies that are listing on the CSE. You can have the greatest company in the world, but if nobody knows about it, who cares? Who cares? So, Dan, let's explore the storytelling aspect just a little bit.
Yeah, that's right, Barrington. A lot of companies are coming to us, and similar to MMP, similar to BLG, where they want to enter the ESG conversation in some capacity. And our response to them is, well, what do you value as an organization? And in many different and it's going to differ based on different sectors. So Ross was talking about some of the stigmas associated with mining and some of the residual effects of wastewater and tailings. So if environment is a big concern in mining, let's, pardon the pun, unearth those stories. Let's tell the stories about what we're doing to take care of the environment and what we're doing to take care of wastewater and tailings rock and things of that nature. Cannabis, very, very interesting situation there. You're seeing a lot of the US MSOs prioritize things like expungement and things like that within minority communities. So the social component is a big focus when you're talking about cannabis companies. So that would be what we want to try to unearth there is we're not trying to boil the ocean. We're trying to delve into what each company cares about in the ESG arena and tell those stories to the market, because we can't assume, in Ross's case, we can't assume that the market knows how his company is taking care of local farmers on private land and their families. We can't assume that they know that. We can't assume that that's baked into the valuation either. And there is a high correlation to companies that are responsible to their communities, to their employees, to the livelihoods of each, to the well-being and the growth of their company as well. So those are the kinds of things that we look to do when companies arrive at our doors.
Thank you. And Lynn, I've just wandered in. I'm talking to you. I'm really struggling with the weight of ESG on my shoulders, and I want to do good, but I also want to make some money. Please help.
Thanks. Yes, I guess I would echo a lot of the comments that were and advice that's been given. I think it's excellent. And, just going back to what Ed says is it may seem a little bit overwhelming, but actually people may have done a lot of the ESG, have that going on in their companies already. And so it is kind of just sitting around the table and trying to define what you're doing now in the ESG area. And it may be that you have a very good basic beginning blocks for your ESG story. And also, I think what's important is what John said is I'm come at it from working with institutional investors. And you got to think about how those people are going to use the story and how important it is, your story is for what they do and how that translate out to their own regulatory obligations and their own stories to their own investors in their products or funds or whatever it is that's, they're seeking capital for. And that is really important. And I think companies should not feel too overwhelmed. Institutional investors will, as has been said, that they'll look at what is relevant for that business. You don't have to report on every single metric. As we talked about, what's important in cannabis versus mining versus in the financial institution space. It can be very different what is the significant ESG and how you interpret it. But ultimately, that institutional investor will want to know what your story is. And if you're not telling it, they're going to create your story. They're going to find information on your company in different ways and categorize your client, your company one way for their purposes. So tell your own story would be my advice. And I liked some of the advice from the group.
Okay, thank you.
Barrington, if I could just add one thing. What's interesting to me too is we hear, well, let's get our story perfect before we go public. And you actually have this really unique adoption period right now with, as you start embracing and looking forward and setting targets, you're telling the real story of, here's where we're still challenged. Here's what we're working on. This is what we're striving for. And we're using that as a report card to come back to you. Don't just get the story perfect. Tell your story. And then this kind of dovetails with what everybody's been saying. Don't wait for the perfect. Get started now. And there's actually a greater appreciation for the users of that information, like your investors and banks and everybody, with you're making meaningful steps as opposed to I'm just being waited told I have to do it.
Yeah. I heard a great comment a week or so ago from one of the senior partners at Bain Capital. And I think this should inform the thinking of the issuers and the investors both, and the folks like us who are advising them. And that is, when investing, it's never a bad idea to be on the right side of history. So as a company, as the issuer, you have to, that's the story you need to be telling. We're on the right side of history here. We're on a trajectory that will get us to a better place. And if you're in a position to communicate that effectively to the investor population, as I say, you've got a tremendous opportunity to stand out from your peers.
Thank you. Ross, go ahead.
Yeah, I'm not sure who said it, but the reality is, for a small company like ourselves, we look at the boxes to be ticked over our shoulder. We're doing stuff that we don't realize that we're actually fulfilling a social objective. And we can identify the environmental side. That's very easy. That's science. But the social side, I mean, building a soccer field in town doesn't cut it anymore. These people want to be part of the process. They want to feel proud about the company that they're working for. And that's what we're striving to do in Ecuador, and hopefully then Peru as well. So.
Well, Ross, I literally wanted to say you opened a can of worms with this, but it's more like a can of bugs and the BacTech bugs. So thank you so much for this portion of the show. I just want to give a special thanks to all our panelists that appeared today and who have sponsored this, MNP, BLG, and National, and of course the CSE. Thank you so much for your time. If you enjoyed this and want to see more content like this, please write www.thecse.com. You can also reach out to me individually. I've been your host, Barrington Miller, Director of Issuer Engagement at the Canadian Securities Exchange. This has been a special presentation and of our seminars and webinars. We will continue this, and thank you and good night.